Hello, everybody. Welcome to Friday, another Talk Money with Tom show. It's starting over again just because we had some technical difficulties, but really excited to have you here today. Super excited about this new studio. When we get it to work right, it looks fantastic, actually. Essentially, this is what it looks like. We've got this great scenario where we're trying to, combine what happened here in California with Hollywood and the techniques. We're in Silicon Valley, want to use the digital, expertise. We got a big picture here of the, San Jose skyline. It's really cool. And again, just to show you, we're actually in this green room that we created. So kind of fun all together for us, to make this happen. The format is still the same. We're trying to help people get a better retirement, right? And we answer questions doing that. Some of these questions come up in our strategy session, so we're focusing on some of those today, and other questions that have come in through comments on the YouTube channel, or you can send them right into this email address right now if you want. If you have a question that comes up, you can put it into the chat also, and we'll try to answer those. And so really, we believe that the more you know about retirement, especially how to manage your money, retirement planning, and tax planning, the better chances you'll have of a more successful retirement. Whether you're looking forward to retirement, already in retirement, a lot of these things will still apply. And so if you'd like to subscribe to the channel, you can do that. I think that's one of the ways that you could up your education, so to speak. You hit the subscribe button, the little bell, and it'll basically allow you to get notified when we put something new on there. We have 800 videos on here now, so you can go through those and take a look and see if there's some things there that can help you also. So the other thing you can do is you can book an appointment. And so you go to the link for the website, which is on the channel here. Right on the homepage up in the corner, you'll see a button that looks just like that for book an appointment. You can meet with Ethan and I, 30 minutes, phone call, video, whatever works for you. And we can kind of, figure out whether there's something we can help you with or answer some more specific questions if you'd like to. So really great environment. We've been doing this for a little over a year now, and really looking forward to continue to be able to answer your questions. I do like to start off each week with a summary of what I saw happening in the market. This particular week was interesting because it's only a 4-day week. This is Good Friday, so there's no market activity happening today, at least here in the U.S. And so, I want to talk about what has gone on so far, but I really want to focus on a subject that keeps coming up. People keep asking me, is this a good time to be buying into the market? Should we be, selling out of the market, or should we be holding, right? So, and I'll talk about kind of things I see in my opinion on what you might want to be doing right now as far as that goes. So we'll start off with just taking a look here quickly at what's happening with the, got another problem, oh, there it is. What's happening here with the S&P 500. So this is the S&P 500 year to date. The chart you can see, the blue line is the 200-day moving average. And so the high point was really the second day of the year, and the low point was the 24th of February when Ukraine was invaded. And so interestingly enough, that differential between those is 14.6% on the S&P 500. We're currently down 7.8. So we've actually come up, interestingly enough, since the invasion started. We had that great run-up at the end of March that you can see there, and then we pulled back, and we pulled back about halfway back. And the last 4 bars there are this week, and you can tell really not a lot happened this week, actually. Up and down quite a bit, but didn't go anywhere. So one of the key things that I look at when I'm looking at these things is just from a technical standpoint, when you have a big run-up like we had in March, I was talking about how we should have some type of pullback. The most common buy point on pullbacks is about a 50% retracement. And that's exactly where we are right now. So in terms of buy, sell, and hold, this is a point where a lot of people that look at technical analysis are actually buying into the market because of this pullback, right? So that's one piece. The second piece to really look at here is just earnings, because that's what's happening right now. This is earnings season. We had the big financial institutions, the Goldman Sachs, the Morgan Stanleys, Wells Fargo, Citibank, all report earnings this week. They did well altogether, right? So good stuff. But this particular chart, I think, is very important. Earnings are the key for what drives the stock market in total. So those expectations for continuing growth in earnings will drive the stock market forward. And you can see here in this chart, the blue line is the S&P 500. and the black line is the earnings, and pretty strongly correlated. And I think there's a couple things there that I look at. Number one is the earnings are on a tear. Since the bottom of that pandemic, that slope is very strongly up. That has a lot to do with this money that was pushed out by the government in order to try to support the economy and the unemployed and all of these different situations during this pandemic, especially when we closed everything. So very, very interesting period of time. Earnings have been fantastic. 7 quarters in a row, we have exceeded expectations for earnings on the S&P 500. So let's see what happens here in the first quarter, but earnings have been very good. And really, when you look at the profit margins that are coming from companies, this is one of the big issues that people are talking about. When you have high inflation, costs are going up, does that squeeze profit margins and bring earnings down? And so this particular chart shows the profit margins as a percentage for the S&P 500 by quarter. The dark blue lines there are, the past. The gray lines are this year, first, second, third, fourth quarter. So notice that little red arrow there. You can see actually the profit margins have been coming down. And the expectation is 12.1% for this first quarter. Maybe it'll be higher by the time we're done. We'll see as far as that goes. But the thing to keep in mind here is that the profit margins are astronomically high prior to this. And you can kind of see that. If you look back before 2021, you really see more of an average. So we're way above average. As a matter of fact, this next chart kind of shows by industry. So the most profitable industry here in the S&P 500 is real estate. Second is technology, et cetera. And the dark blue line is the projection for the first quarter. The green line is the 5-year average. So the expectations are we're going to be at or a little bit below or a little bit above average earnings. So that's a good thing. And so as long as they continue to grow, the stock market will continue to grow also. Earnings are critical. I mean, we talk about all of these things with the Federal Reserve and Ukraine and China's zero COVID policy and supply chain issues. All of that is how do they impact earnings? That's what we're talking about. And so earnings season, like we're in right now, is very critical. The last several quarters, we've had the market dive down based on the numbers for inflation that came out, and then earnings came out and the market came back up because earnings were quite good. Although it does seem to be the second half of earnings season, especially when the big tech companies, report and such, where that happens. But so this will be very interesting to watch as far as that goes. Looking forward to that. And then just getting back to this, buy, sell, or hold. I've done a tremendous amount of research looking at different things, and one of the pieces that I look at is if the S&P 500's 200-day moving average is still going up, okay, so that's the blue line here, still going up, and the leading economic indicators have not curled over and started to fall, that is a point that I'm not going to sell. I'm not going to sell until both of those are going down, the 200-day moving average and the leading indicator. So this particular chart is a basket showing a basket of 10 different indicators. It's called the leading economic indicator. The gray bars are recessions, and the blue line is the indicator. And if you look closely all the way back to 1960 there, in almost every single situation, the indicator curved over first before that recession started. So I'm at least at a hold here, but we have been using some of these points in time to rebalance. So we rebalanced the portfolios on Tuesday when the market came down a bit after the inflation number. We hit that 50% retracement, and so rebalancing is kind of like in between a buy and a hold in a way, because we still have the same portfolio. We're just rebalancing. We're going to sell little bits of something that did quite well versus everything else, and buy little bits of something that didn't do as well. And as long as you have great confidence in all of the parts of the portfolio, rebalancing in this environment is, I think, a really good idea. And so we've had some good results with that so far. So that's what we're going to be doing. So at this point, we're not in a sell position. I know that a lot of people are worried about things that are happening, and most of the news is negative and talking about recessions and talking about Ukraine and those types of things. But at the moment, we're not seeing recession on the immediate horizon here. The market does look forward 6 to 18 months. We're not seeing a recession really even in that time frame either. Could happen. We'll respond to it and deal with it. But at the moment, definitely, a buy and or hold depending on the situation. So that's what's happening as a whole. really look forward to seeing what we might be able to do next week. Let's talk about some of the questions.
Yeah, so our first question comes up a lot in the last few months. Is how do I invest in a high inflationary period? So the consumer price index came out at 8.5, which is the highest since the 80s. You know, everyone goes to the gas pump and sees those high prices, and we know inflation. We see it every day.
Yeah, it's a great point altogether. Lots of questions from the clients about this too. Because like you say, the number was so big for March. It's kind of scary, as far as that goes, and I get it. And so, how do you invest? What do you put your money in? I'll give a warning first. I have seen so many articles and had so many questions, and essentially people are making pretty radical moves, right, into areas that will do well in inflation. And they're overweighting their portfolios into that particular area. Well, what if we don't have inflation, right? The market is not that predictable. You can't say for certain that something's going to happen. You got to keep a really good balance for starters. And if you're going to move in one way or another, it should be smaller portions of a portfolio. So you got to keep that, overall thought process in mind. Because, all of the news is about how much inflation is here and how it's going to keep going. And it's just incredible. And again, fear sells, so that's what they're going to focus on. There is another path to understand that inflation could pull back to be a lot less by the end of the year, beginning of next year. And everything that you might be buying right now to try to fight inflation could fall or do worse than the market if that does happen. The market's looking forward 6 to 18 months, right? So think about that. If the inflationary environment gets significantly better in the next 6 to 18 months, all of those things that you're trying to buy now would be at a peak, right?
Yeah, and there's a kind of this term, this bias that we have that you talk about in behavioral finance is, are we getting anchored to a specific idea? And then when we look at the news, are we only looking for news that kind of confirms that bias? And so we don't want to get stuck to any kind of idea because we don't know if this idea will hold in the future. So we need to be flexible.
Yeah, exactly. So that's the thing to talk about. So let's just look at the other side, why there might not be inflation as much in the next 6 to 18 months. And a lot of that has to do with the situation that we're in. So I just read this great article that after World War II, all the soldiers come back home, and there's just this huge pent-up demand. And we've got this scenario where people want to buy houses, they want to buy cars, they want to buy nylons, and all the production is geared towards wartime production, making airplanes and different things along those lines. And so it's similar to what happened here, right? Got the situation where everything got locked down and shut down, and then the production was stopped. And everybody's coming back now and want to buy things, and the production takes time. And so we had this high inflationary scenario after World War II that eventually worked its way back down to a normal inflationary scenario once the supply could be redirected and restarted for the things that people really wanted at that time. And then we ended up with a pretty nice period, right? The end of the 40s and all the way through the 50s was a really good time period economically. The stock market did well in that time frame also. So I think this particular correlation, that's the strongest we can get for a modern correlation. You have to go back to 1918 for the last pandemic. We did end up with the roaring 20s, right? Starting about 1925 to 1929. That was the second biggest run in the stock market on a 5-year period in history. And so, we'll see how this plays out, but this is not normal. This is not like the 70s and 80s as much as it's like the end of World War II and the situation that happened in 1918 with the pandemic. So, and I think a lot of people are kind of missing that. So let me share some things with you here, and we'll take a look at that. So first of all, this particular chart just shows consumer spending, and you can see here that it was very smooth. Prior to the pandemic, just marching up very nicely, actually. And when that happens, production can keep up. Things are okay as far as that goes. And then that gray line there shows kind of that recession that happened because of the shutdown of everything. Look at what happened to consumer spending. It just plummeted People were afraid.
Yep.
And then some places we couldn't spend the money. Right? There was no restaurants to go to. There was no planes to get on. Airline miles dropped 96%. And then we started to reopen. And you can see that blue line comes back up. And what I did there is I drew in a little red dotted line if we just had kept on the same, path, exactly along that same path of growth. And not only did we catch back up to our normal expenditure growth path, we passed it.
Yep.
Right? And so we passed it for two reasons, in my opinion. Number one, trillions of dollars were pushed out by the government in stimulus to try to make sure that we didn't end up in the next Great Depression because of the shutdown. And so that money is just burning out there. It's coming in. And then secondly, there's this pent-up demand. Some of us are, hey, we're sitting in our house, want to go do things, want to be able to spend on things. And maybe there's a retail therapy that helps there. I know for me, Amazon, probably got a lot of my money. So, just things to do when you're stuck at your house. I did a lot of things around the house, for example. So we have that, right? We have this big spending. Demand comes back. It comes back very quickly because it's super easy to pull out your credit card.
Yeah, like I can go to Amazon, swipe my credit card, but to make that production, when you shut down production, you're either laying off people, putting them on furlough, and then ramping that back up and getting all the chain, every part, and everything moving back in order again is pretty hard. And when businesses during that pandemic, they didn't know what was going to happen, so they tried to cut as much expenses as they could just to stay afloat. And they didn't realize that demand would spiral upwards again, and so they're not ready for that. You saw that with lumber when no one thought lumber was going to be needed because we're in a recession, no one's building houses, but then everyone's at home doing their remodels, and the lumber prices just skyrocketed.
Yeah, exactly right. So all of these things have been affected by the pandemic itself, and you got to realize how unique the situation is. And this, to make your point, here's a chart on employment, right, which is well behind the trend. So if you look, prior to the pandemic, really smooth again, nice trend. I put in that red dotted line to show the trend continuing, if it would have stayed on with no pandemic. Massive number of job losses, 15 million jobs lost overnight, essentially.
Yep.
And now we're climbing back up, and we're actually closing at a pretty fast rate. You can see that line coming up is pretty steep, but we're not caught back up. And so it's so much easier to order something than it is to get it set up. So restaurants reopen, great. Everybody wants to go to a restaurant. That's easy to decide. I can do that. It's very difficult for that restaurant who just let go of all of their employees to then rehire. They got to interview and rehire and train and get back in. And then we had problems actually getting people that wanted to come back out to work. So a big chunk of people retired earlier than they might have. And other people had kids at home, and then in some situations there was just people afraid of the virus because a lot of the jobs that were reopening and that were lost and tried to rehire were facing, public-facing jobs. And so it's just as one example. And so you can't produce as much services or products without humans. And so if you don't have as much humans, you're not going to have as much products or services. And if there's still money chasing those, their price goes up, people still might pay that, and they have, right? I mean, we've seen this go on and on so far. So even though prices have gone up, people are still buying, right? And so that's what causes that price. But there is a potential here that things start to work their way out, right? That humans start to come back to work at the right rate to meet that. There's 11.3 million jobs open right now.
Wow.
So we still got a little ways to go. We got to get people back out to the workforce. But the job numbers have been really good recently. 400,000, 500,000 jobs a month being created. We'll catch back up to that line here, possibly sometime this year, depending on what happens. And so that we need to get, supply kind of matching this demand. There is another component, though, in the fact that demand probably starts to slow down, at least that growth curve. If we go back to where we were here, so if we see that personal consumption, I wouldn't be surprised to see that come back down to that red line at some point in the future for a couple of reasons. Number one, we're no longer putting out big stimulus. There's no child care credits. There's no, big infrastructure bills. Build Back Better program doesn't seem like it's happening. So there's not a lot of new money coming from the government. You have a scenario where savings are starting to be burned off.
Yeah.
And we've got another scenario where the Federal Reserve is trying to slow things down. So far, they've only raised rates 1/4 of a point, but they could. They've used their words to get rates to come up a lot. The 10-year Treasury went from 0.5% to 2.8%. Mortgages went from maybe 2.5% to 3% to now 5%. That's going to slow down demand.
Yeah.
Because there's going to be a situation that happens where people just don't have as much money to spend on all these things. The combination of demand coming down a little bit and supply coming up some could get us back to a situation where we're at, say, 3 to 4% year-over-year inflation by the end of the year. All of those things that people are buying right now to high inflationary things would probably underperform the market in that time frame if that does happen. So I'm not positive what's going to happen, but I don't think a lot of people really have the full story about inflation in terms of, how it could resolve itself versus just running away for the rest of, the next 2 years or something.
Yeah, the Fed's not going to let the inflation run away. If they let it run away, it just becomes a death spiral for them.
Right.
And so you have to also remember that the Fed's going to try and react, but there's going to be a lag period. Inflation is a lagging indicator. It's not going to be, you're not going to see it instantaneously. They raise rates and then, everything comes back into par.
Yeah.
It's going to take some time.
It does take some time. Exactly right. So, so now, in terms of the portfolio, to go the right direction here, this is our current 60-40, 60% bonds, 40%, 60% stock, 40% bond portfolio. And I'll go through this kind of piece at a time because I think it's important. If you look at two of the big blue pieces there, the first one is the Vanguard Total Stock Market Index. It's an exchange-traded fund, ticker symbol's VTI. That is the most diversified U.S. exchange-traded fund that I can find. It has 4,124 stocks in it, basically almost all of the tradable stocks here in the U.S. And so the reason we have that is because we don't know. We don't know if inflation's going to run or stop. So we own all of it. We have the large cap, the micro cap, the small cap, the mid cap. We have everything. We have growth. We have value. We have financials. We have energy, right? We have all the pieces. It is driven more by the bigger stocks, but nonetheless, still we own everything. And then the second big blue piece there is the S&P 500, and that's the Vanguard's VOO is the symbol for their exchange-traded fund. Now, we already own that in the previous piece, right? Because we own everything there. And what we're doing is we're concentrating some money into those companies. They have a great chance of handling this environment. If inflation goes up or doesn't go up, these companies have loyalty, they have cash flow, they have earnings, and they are very, very popular in terms of a stock around the world. People try to buy the S&P 500 when they think about buying American stock. So those two pieces are very, very broad, very diversified, and I think they're important to have in the portfolio in large quantities. And if you skip over to the two first green pieces here, the first one is the Total Bond Market Index from Vanguard. Again, this is a very, very broad bond market index from Vanguard's exchange-traded fund. The ticker symbol is BND. This has over 10,000 bonds in it. And again, inflation goes up, you're going to have trouble with treasuries and maybe better in some of the higher yielding corporate bonds that might be in there. If inflation goes down, treasuries, could stabilize and start doing quite well. So we're not trying to guess with that. We got a majority of the bonds. And the one next to it is the iShares Total U.S. Bond Market, which is IUSB. That has 13,000 bonds, so even more diversified. So if you look at those four big pieces, that's 66% of the portfolio. So this is what I'm afraid of when I read these articles and somebody produces an article saying, here's what you should buy for your portfolio should look like this. It's all the way over on the spectrum. It's all inflation. I think that's a mistake. Only going to work if you happen to be right and inflation continues to grow and grow and grow. going to be dead wrong if it doesn't. And so keeping that monstrous diversification first for majority of portfolio, that's my first piece of advice. I think that's super critical. Then we have in the blue there, we have four little 4% pieces. These are our targeted index pieces. And these are things that I think could do well in this environment and maybe even survive in multiple of different environments. So there's a short-term real estate piece, Microsoft and Apple and semiconductor. Those do well in inflationary environments. Potentially they do well in non-inflationary environments. You know, Apple, Microsoft have great loyalty. They can raise prices and generally still keep their margins, at least so far. They have huge cash positions, you know, those type of things. So I'm very interested in companies I think can survive or have huge demand or have higher dividend or whatever it is, right? So that's the targeted area. That I change depending on kind of what I think might happen. But even there, right now, I'm trying to stay pretty broad in concept. And then the last two pieces, last three pieces of the green are inflation-related bond issues. So Treasury inflation protection securities, which are treasuries that are issued, and their yield, their interest rates go up as inflation goes up, keeps the price more stable, right? I've got two of those, and we have an interest rate hedged high yield, which has actually been doing quite well versus the bond market. And so that's our, push towards inflation protection on the bonds portion of the portfolio. Again, we'll have to make some adjustments to those if inflation doesn't turn out to be an issue as things go. So that's the mixture, what I would call surviving inflation and how you want to invest. Please have a balanced approach to the thought process of whether inflation is going to be ramping up here for the next 6 to 18 months, because that's what you're investing for, not now. It's for the future. And then have some balance in the portfolio and make your guesses, your targets, smaller and manageable. And even then, try to keep them pretty broad as far as that goes.
Yeah, you never want to commit to something, too much of a good thing can always turn out badly.
Yeah, exactly. I think 2020 was an interesting year where things got really narrow because so many things closed. That's probably the first year in my career where we got a bit more narrow because it kind of had to. The broad market had so many pieces in it. Energy was down, airlines were down, all the service industries were down, hotels were down, because they're all closed for all intents and purposes. So, this though is just more like a normal year. Yes, we're having some inflation, but this is the cause of this is a reopening. And normally in a recession, like we had for a couple months there after the pandemic, you get this slow comeback in demand because people don't have jobs, they don't have money. This is totally different. The government put out money, and we got lots of openings, and people had savings. They didn't spend as much for a while, and so a reopening is a totally different animal than a recovery. Right? And so I think you got to keep that in mind when you're looking at inflation. Eventually the reopening kind of works its way out. Hopefully this is more like what happened in at the end of World War II, right? Than it is what happened in the 70s and 80s. All right. What other questions do we have?
So we had a question that came in our comments this week. If I had stocks that dropped heavily in my 401k, does it make sense to do some tax loss harvesting, or does it even matter?
Yeah, so you've got three different buckets of money. And this is part of the educational process, is really understanding what these three buckets are and how that works from a tax standpoint. So first of all, you got a taxable account, right? So that could be an individual account, a trust, brokerage account, a transfer on death, lots of different names that people use for those. But essentially what happens is whenever you make a sale or a purchase, sale mainly, you have to account for it on your tax return. Did you make a gain? Did you make a loss? Any dividends and interest that are paid out end up on your tax return that year, right? So that is a taxable account. And then a tax-deferred account, again, we call these IRAs, 401ks, 403bs, 457s, but they're all the same in the sense that when you put money in, you get a write-off. You don't have to put that on your tax return that year. But when you take money out, you have to pay taxes, right? Pretty simple. But what happens in between times in terms of the buys and sells, you don't have to account for that. Right? It's not on your tax return. And then we have tax-free, which is really the Roth IRA and the Roth 401k. And again, no tax write-off when you put the money in. You have to pay taxes on that money as it goes in, but it grows tax-free and you get to take it out tax-free at some point, right? So what the question was about the 401k, which fits in that tax-deferred bucket. There is no accounting for the buys and sells. So if you bought a stock for $100,000 that's now worth $75,000, and you sell it, nothing happens.
Mm-hmm.
There's no write-off. It doesn't matter because the only thing that matters in that case is when you take money out of the account itself.
Yep.
If that was in a taxable account, it would matter because you could take a $25,000 loss. And then it would allow you to maybe take $25,000 worth of gains on other things if you wanted and not pay taxes because you could wash those out against each other. It's more complicated than that, but in essence. So the answer is it doesn't really matter whether you sell that stock. You might want to sell that stock because it's not doing well or some other purpose, but it doesn't matter from a tax standpoint to sell that stock that you lost money on inside that 401k.
Yeah, and the nice thing about your tax deferred and tax free, you can be a little bit more aggressive with your transactions in a sense. You don't have to worry about these capital gains, and so the only time you get these taxable events is for your tax deferred is when it comes out as it'll be just an ordinary income, and when you put into a tax free account, you're paying up the taxes in the front, so you already pay taxes, and so they're not going to tax it again.
Yeah. So it's a good question. We do get that question quite often, actually, and I think that's part of the educational process is understanding these buckets, and they're really important to understand, in our opinion, in order to maximize your retirement. All right, what else do we have?
So this is a question that we've seen multiple times when it comes to planning is I'm about to retire. I have a large portion of my assets in a rental property, and then I have a smaller amount in kind of my retirement accounts. What do I do with this rental property? Do I keep it? Do I sell it? What do I do?
Yeah. So I'll give kind of a bottom line answer, and then we'll look at a little example here because we do get asked this again quite often. And so let's say that we do your financial plan and run your Monte Carlo simulation, and we ignore the value of your property. We maybe count the rental income, but we look at your assets, your incomes, your amount of money you want to spend to live off of, and it works. Then you don't have to sell your property, right? On the other hand, if we run the plan and it doesn't work, and the Monte Carlo simulation says, oh, this is going to be a problem, then we need to consider selling the property at least at some point in time.
Yeah.
And so I think one of the things we have to think about here is that these questions that come up, sometimes people are kind of guessing at the right answer. We're using this Monte Carlo simulation, which I think gives us a lot more information to find the right answer. So let's just look at a sample situation here. We'll try to show you that as far as that goes. Okay, so we've got somebody here. This is kind of a net worth statement. Comes out of our financial planning software. They got $398,000. This is Ron and April, right? Yep. Sample situation. And we've got this scenario where we have $1.5 million in other assets, $1 million of which is in that rental property.
Yep.
Right? And so we then go and we want to run a Monte Carlo simulation. And again, behind the scenes here, we have all their assets, which we just looked at, but we also have their outside incomes. How much is coming in rental income, how much is coming in Social Security, pensions, and we have how much they want to spend.
Yep.
Basic expenditures, travel, medical costs, when they want to buy a car, all those things are built into this. And we'll run this Monte Carlo simulation. When I push this button, the computer's going to run the plan 1,000 times, and it's basically going to go to a scenario where you look at it and say, all right, how many of those times did it work?
Yep.
And so the computer's randomly moving amongst these different variables like inflation and the stock market gains or losses and this bond market gains or losses, right? And those types of things. And this is a great way of looking at it. So when we push the button, we end up with a scenario with this green spaghetti and red spaghetti. And how did it work? All right, so it comes out with a 48% probability of success, right?
Yeah, that's pretty rough. I'm not looking to retire if I'm just going to be a coin flip.
Yeah. Now, we didn't count their property value, right? And so one of the things that has happened, especially recently and especially around here, is that the rents have not kept up with the valuation growth. So maybe you're only getting less than 2% of the value of the property in rents each year, right?
Yeah.
So it's a kind of an underperforming asset as an income,
Yeah.
overperforming as an appreciation. Right? That's doing great. The problem with that is that you can't eat the appreciation, right? That's what Mike's
Yeah.
saying. I can eat the income that comes out of that, and I got my other assets that I could live off of, right? But that only adds up to 48% probability of success.
Yeah.
That's not good enough. So I need to sell that place potentially, right? If I want my retirement to work, or change my plan.
Yep.
Cut back my expenses dramatically and have a different lifestyle, right? And that's possible too. I've seen people do that. But let's just take a look at what happens in a Monte Carlo situation if we do sell the property. So here we have, Ron and April. We've got their list of assets, and you can see here with this big red arrow, we now are putting in a sale of this property, and let's just say after taxes, $800,000.
Yep.
So that's now coming into this diversified portfolio, right? And that's cool. And so what we get then is another chance to run Monte Carlo simulation with a different situation with this 800,000 in there. And when we run that, kind of push the button, we end up again with this green spaghetti, 96% probability of success.
Yeah. That's a great retirement there.
Right. So it just went from a retirement that won't work to a retirement that will work by selling their rental property, right? Now, we can test that. We can look at selling the property in a couple of years or 5 years if you think it's still going to appreciate. There's all kinds of different things that we can do here in kind of a what-if scenarios. But overall, the concept of keeping a rental or not keeping a rental, this is, to me, one of the better ways to answer it, right? I'm not going to guess. I'm not going to get out a spreadsheet. I can't do Monte Carlo simulation very well without this particular type of program. I'm not going to get out a pencil, a calculator, and try to figure it out. This is the better way to do it as far as that goes, as far as I'm concerned. Honestly, we used to do financial plans on a yellow legal pad and an HP 12C. That's what we did. And so I know what that's like, and I know how much better this information is and how much better the advice is now versus, what we used to do as far as that goes. So,
Yeah. So one thing you can think about is this retirement, even though you lost 200,000 in net worth from expenses for the selling, you got to pay taxes, you have to pay closing costs, you need to do some renovations to the house to be up for sale. And so even with that, you're doubling your kind of success percentage, even though you lost 200,000 in net worth.
yeah. So good stuff. Really, enjoy trying to help you out here. Sorry for the blip at the beginning of our show today, but we did manage to get through the content that we really wanted to highlight today, and look forward to being able to continue to do this. We actually will not be here next Friday. I'm on vacation for that particular day, but we will be here the Friday after that. So look forward to seeing you then. Please send in questions at any time. Right, you can go through and send those, and we'll build up a story around them and try to answer them really well. And then, secondly, of course, you can subscribe to the channel, which is a great thing to do in my opinion. And then, of course, you can book an appointment too, of course, right? If you want to meet with us. So, really excited to be able to help you out today. I want to thank you everybody for joining us very much, and I look forward to seeing you